guess you have to define what soft means. I think focus.
180,000
Yeah, I mean
0.3% on the average hourly.
Yeah, I think I was about to mention. I think it is clear that the labour market is coming into balance, and therefore there's less of an inflation pressure coming from the labour market. This much has been recognised by the Fed. I do believe, however, that if we get a reasonable number, I mean the numbers you've mentioned, that could still continue to help the Fed to push credibly against the expectations of very aggressive rate cuts up front. So from that point of view, I mean, defining weaker number, I would think that it will take much weaker number to really undermine that credibility, because ultimately the US is still enjoying a relatively healthy growth, and a big part of that is the behavior of the US consumers that continue to spend, and that is then supported by the fairly tight, still relatively tight labour market. And I should mention also, obviously, that if you put that into the context of other economies and things happening around the world, really not all economies are enjoying so much growth, in particular the Eurozone, if you wish. So I think that ultimately it's really a matter of credibility, of how credible the pushback against the rate cuts would be from here, and the Fed would still have that credibility.
The disinflationary process that has begun, and we've seen fairly extraordinary moves on the inflation number versus expectations, right? So if we look at the labour market and confidence, it feels like that is key, because it's still the cushion that many policymakers are looking at. We've also got the Consumer Confidence Survey out, the University of Michigan survey. That seems like it's going to be quite key. But any fading there more than expectations, surely that does have an outsized impact this time round for a lagging indicator.
Well, potentially it is. As I was saying, if it's a soft number, indeed, as you said, investors have been quick to push pare back their rate cut expectations following Powell's press conference. That could indeed come back, but ultimately I think it has to be a fairly weak number, something maybe 100K or even lower. And once again, I think emphasis really still is on wage growth, how much of a wage growth the labour market is producing, and I think that will provide sufficient reason for the Fed to hold off for now, really just to really resist any calls for cuts.
Valentin, I haven't mentioned it, but I actually did an interview with Andrew Bailey yesterday. I don't like to talk about it, but actually it's really interesting. Out of the pressers and my interview, I thought the word that came out, the key word, was evidence, which is interesting, because you went to, and I'm revealing something off air here, you went to an analyst meeting later with a couple of the MPC board members, and the word you came out with was structural. So just tell us a little bit, because I think we've done the evidence bit, i.e. they're waiting for more evidence before they can cut rates. Why do you think structural was the key word out of the analyst meeting?
Just for the record, the structural was heavily featured in the monetary policy report, so nothing really new about that. But it is the case that the UK has been enjoying, so to say, really fairly persistent inflation, and a big part of that were really structural drivers, like essentially lack of sufficient labour supply for a number of reasons. Really, we had COVID, we had obviously Brexit, and so on, and those factors persist. And because of those factors, even though the economy has been relatively weak, wage growth remain quite sticky, very elevated, and as a result, the UK still has the highest services inflation among G10 economies.
When I pushed the governor on the market's interpretation of roughly 4 rate cuts in 2024, he didn't push back at me aggressively. Yeah, he's relatively comfortable with that as well. So are we all on the same page, unlike in the United States, where market's going for 140, 50, Fed's going for 75? The market, the gilt market, analysts, journalists, and the Bank of England seem to be on the same track. Is that wrong interpretation or right interpretation?
Well, our own view is that there'll be 3 rate cuts this year, so a bit less than that.
But there or thereabouts.
It is the case that, the market expectations are not that excessive, especially compared to other central banks. If anything, on the whole, what this means for the pound is that the UK, the Bank of England could emerge as the relatively more hawkish central bank out there, and therefore we remain relatively constructive on the pound against the euro in particular, as in the euro becoming the new funding currency of sorts, and the fact that we could have more persistent inflation, really, or indeed the BOE maybe having to deal with that for a bit longer, really is supporting the case that they will be less willing to cut rates aggressively or early enough.
We have a very packed show and we have to leave it there. Lovely to see you. Thank you for coming in to join us to talk about this as well. Dr. Valentin Marinov, Managing Director and Global Head of G10 FX and UK Research at Credit Agricole Corporate and Investment Bank.
Coming up on the show, European leaders agree on further aid for Ukraine after weeks of negotiations. Sylvia will have the latest after the break. European leaders have come to an agreement on an additional 50 billion euros in aid for Ukraine. The deal was reached after months of negotiation, with Hungary rescinding a veto. Ukrainian President Volodymyr Zelensky welcomed the decision, saying it sends a strong message that Ukraine and Europe will withstand any challenges. Sylvia, just to walk us through this, because the Hungarians were standing in the way of this package. The Europeans were threatening to blackmail, apparently, in terms of some of the economic packages. So just talk us through the breakthrough.
So, in essence, I'll just focus on what matters. Ukraine is getting 50 billion euros from the EU starting in March if the European Parliament approves this, which is very likely. That's the scenario that we have on the table at this stage. So that is a positive development for Ukraine. And with that in mind, I just want to show you these comments from the Ukrainian president, Mr. Zelensky. He thanked the EU leaders for their support. And then he also made a comment that Europe is sending a signal across the Atlantic and around the world that the international rules-based order will endure challenges. And this comment is particularly important because, of course, at this stage, there's also that huge question mark about whether the United States themselves will actually send further financial support to Ukraine. So I just wanted to focus on the big development here on what this means from a practical point of view, and that is that Ukraine is getting these funds from the EU. Now, the other side of the story is what happens when it comes to Hungary. They have delayed this disbursement for several months now. What happened at the summit yesterday is that they got 3 concessions, and I'll just outline them for you. There will be an annual report by the European Commission on the implementation of the aid package. In 2 years, the leaders of the EU, the heads of state, will have the chance to talk about these funds for Ukraine once again. And then there will also be another debate among the leaders when it comes to this package. From a practical point of view, what this also means is that Hungary didn't actually obtain anything significant. What they obtained was actually just more paperwork. But then I just want to focus on the narrative that is taking place among the EU and Hungary, with the Hungarians saying, we fought it out. Hungarians can't give money to Ukrainians. We do not participate in the war. We do not send weapons. We are still on the side of peace. And I just wanted to highlight this comment as we approach the European elections. But all in all, a positive development for Ukraine. And for now, you do see the 27 coming together.
Thank you, Sylvia. Yeah, really good report and very succinct on the actual points that mattered. Thank you so much indeed for that. Right, let us move on. Coming up on the show, Wall Street powers ahead of investors. Punish. That doesn't make sense. Wall Street powers ahead. Investors punish Apple though after disappointing sales in China. We'll delve through the numbers after this.
Welcome to the second hour of Squawk Box. Here are your headlines. China weakness takes a bite out of Apple in extended trade, while executives caution on stalling iPhone sales despite the tech giant beating on the top and bottom lines in the first quarter. Cost-cutting does the trick at Amazon, with the e-commerce heavyweight posting record operating income, while Meta shares surge on bumper results and the firm's first ever dividend.
A volatile trade in Chinese stocks, with equities recovering major ground in the last half hour after the Shanghai Composite drops below the key 2,700 mark. And the Bank of England Governor Andrew Bailey hints the market could be on the right track with its rate cut timeline after the central bank votes to keep rates on hold in the first three-way split since 2008.
I'm not going to give a view on how many cuts there'll be or when they will be, but I think that that view that the market's taking is not one I object to.
Higher rates driving a 76% surge in fourth quarter net profit. That's for Spain's Caixa Bank. So we'll speak to the bank's CEO. That's Gonzalo Gordaza. That's happening at 8:15 CET.
going to take you back to the mainland market. It has been a fascinating week. The Evergrande story and liquidation of that large property giant just caused another wobble on the China markets this week. And in the Friday session, an extension of those losses has been taking place. At one point, we've been down below 2,700 points, a psychological level for the Chinese market. And you can see we picked up again. We pushed back above that handle. But the numbers we're seeing taking us right back to 2019 handles. The ailing economy is still front and center for a lot of investors, as well as the property market cleanup. Investors are still very cautious at this stage. Also, a lot of reports around margin calls as we see these falls. And don't forget, some investors thought we'd drop to some sort of bottom and maybe there would be upside, some opportunities this year. But the margin call story is something a lot have been watching in terms of investors having to top up their accounts. But so far at this point, there's been limiting the downside, and does beg the question whether there's been some form of intervention or whether this is just retail institutional investors getting involved. At this point, we're down 2.5% on the Shenzhen market. CSI's picked up, it's down 0.5%, and we're down less than 1% now in Chinese stocks. Across to the Asian markets, the red you're seeing there in contrast to green elsewhere. The Nifty 50 has been trading around a record, so Indian stocks up almost 0.9%, 0.4 plus on the Japanese stock market. And don't forget, this on the back of what was a strong session on Wall Street too, Steve.
Super duper right. Apple beat on the top and bottom line expectations for its fiscal first quarter, returning to revenue growth after a full year of declining sales. Revenue in China, though, and this is where some of the questions are being raised, fell more than expected as the iPhone maker faced competition from domestic players and broader economic weakness. That, alongside guidance signaling weak iPhone sales in the current quarter, sent the shares down just under 3% after hours. Elsewhere, Meta shares surged in extended trade after delivering its first ever divvy and $50 billion worth of additional share buybacks. Net income more than tripled on the year, whilst revenue grew at its fastest pace since mid-2021. The CEO, Mark Zuckerberg, said the company is continuing to focus on efficiency.
Obviously, we're in a place now where the business is performing well, and I think the obvious question would be, okay, well, given that, should we just, should we invest a lot more in things? And the biggest thing that's holding me back from doing that is that at this point, I feel like I've really come around to thinking that we operate better as a leaner company.
Amazon comfortably topped fourth quarter earnings expectations as new generative AI features spurred growth and as the company continued its efforts to cut costs. It reported record sales for the period, while Amazon Web Services revenue rose in line with expectations. Shares moved higher in extended trade. The CEO, Andy Jassy, said AI technology can deliver billions of dollars in revenue upside.
Gen AI is and will continue to be an area of pervasive focus and investment across Amazon, primarily because there are few initiatives, if any, that give us the chance to reinvent so many of our customer experiences and processes. And we believe it will ultimately drive tens of billions of dollars of revenue for Amazon over the next several years.
Not like that.
Let's get to Arjun for more. Arjun, we'll pick up on Meta this time because the cash dividend, very grown up, joins the likes of Microsoft and Apple in paying a quarterly dividend.
It's so funny you said grown up. That's exactly the words I've got written down here. It was growing up for Meta because the story of sort of the past couple of years was this company out of control, investing in all these new areas with no control over how it was spending and where it was going to grow from in this new area of virtual reality and augmented reality. And what the story of 2023 was ultimately was Meta getting its costs under control, growing up, but still managing to show pretty strong growth as well. Its revenue was up 15% in the quarter, expenses down 18%. Its margin more than doubled in the December quarter as well. And then, of course, the dividend as well. And that was what it was all about. And I think it was important from the company also that it was signaling that this focus on control over costs isn't going to go away just because it's got things under control. Now, in 2024, Mark Zuckerberg was saying that the company wants to keep things lean. It's got no plans to accelerate hiring. And while it wants to build this sort of world-class, he called it compute infrastructure, the data centers and chips needed for AI, and CapEx will increase, that there's not going to be a massive investment on the headcount front. And I think that's really what the market wanted to hear, that Meta can keep that cost under control whilst growing. And that's why it even forgave, I think, that massive loss in its Reality Labs VR AR division.
Can I ask you about the how here, how it's executing on AI? because it felt as though we had really sketchy details from a lot of big tech companies about how AI is actually driving performance. There was an element that it's really working for it, but how? I didn't really get how.
No, it's a great point, Karen. I think a lot of the tech companies aren't answering the how, bar sort of Microsoft at this point. I think for Meta, they're talking a lot, obviously, about it. I was reading through the earnings transcript. It was all AI. And what I gleaned from that was, firstly, that they want to use artificial intelligence in terms of recommendation. So we know Meta and all the social media companies have these very complicated recommendation algorithms. Meta, of course, has a suite of apps, Instagram and Facebook and WhatsApp. And one of the thoughts I got from what I was reading and hearing was that they want to use AI in terms of being able to be more smarter on the recommendations and therefore keep people hooked for longer on these apps, and that's going to, of course, help ads. The other point here as well is using AI in the ad products as well. So being able to recommend smarter adverts to users, and of course that should help the advertisers reach more users also. Those are a couple of things I gleaned, but again, these feel like they're very early stage and not quite sort of spread across the entire Meta universe yet.
One trite question, one real question. Do they need to change their name again? Seeing as they've gone from they went to Meta as a nod to the metaverse, and now they're like, well, that's not such a big issue now. It's all about AI. They need to change it to A or something.
Yeah. Meta?
Meta?
I don't know.
That was my trite question. My real question is I'm going to focus on Reality Labs. So they're allowed to just, funny enough, we talked about moonshot technologies in the energy space and how the IOCs or the international energy companies, it's looked really badly upon them when they have renewable moonshots, so to speak. Whereas in this sector, how long are they going to be allowed to lose vast sums of money on Reality Labs and everyone just kind of get it?
Say, as long as they say, we're paying you a dividend and doing 50 billion a share buyback. So I think that's the point, wasn't it? Yeah.
There's some interesting data on what the divvy means, by the way, as well. I was looking at some copy from Howard Silverblatt over at S&P as well. And it has a massive effect. So this $0.5 per share divvy, which is a yield of 0.51 as well, using the closing price, ups the yield on the S&P. This is how highly weighted these companies are. Ups the yield on the S&P 500 from 1.45 to 1.609. Now, that doesn't sound a lot in itself, but it's still a chunk. Again, it's another reason for the power of the Magnificent Seven. So in terms of where the company's going, 2023 year of efficiency, 2024 year of efficiency, Mark II.
Mark II. We're going to continue.
He's realised that's what, if you say I'm efficient and we cut costs, the market loves you. If we don't, then it's all bets are off.
Yeah, and as I mentioned, they're willing to forgive that 4.65 billion loss in the quarter because the other part is it's not just about cost control, but it's the fact that the other parts of the business are growing, the core business, and that is advertising. That is across all apps. And I think it was interesting. Facebook products are effectively blocked in China, but China is a huge part of the company's story in 2023, accounted for about 10% of its sales last year, thanks to companies like Shein and Temu advertising on Meta's platform. And so that was a big boost for the company as well last year.
Can I bring up Rufus? Apparently we're all going to be spending a little bit of time with Rufus. Do you know who Rufus is?
Is it Rufus Sewell? Is that an actor? Is he another one that like Jack Reacher you're watching?
No. Apparently this is the chatbot, the expert shopping assistant at Amazon. But how does this work? We were talking yesterday how Amazon is using its eyeballs now and promoting certain sponsored content. If you have a chatbot helping you with search, to what extent is that going to be immersed with the advertising side, and where are the regulatory issues as well?
Well, it's all convoluted together. The idea. Amazon always had to move in this direction in terms of generative AI. Rufus, this assistant. You go on Amazon right now. You're searching for products, and you can get quite specific with the searches. But one of the things I was sort of reading, or the promise at least of Rufus, is being able to be a lot more specific in your queries, but also ask questions. What is the difference between these two products, and get recommendations on the back of that. So that's one of the areas that it's looking.
Excuse my ignorance. Don't we already have that?
You have to trawl through a lot of information, though, if you want to do it yourself.
But everything's ranked. There are reviews. There are comparable products. People who like this also looked at this product as well. It's all there, isn't it?
It's partly, but the way it was being billed, at least in the promises, you can have a little bit more conversation about with this chatbot about what specific product. So, I don't know the difference between these two type of shoes. Can you help me?
So what are they all called now? What have we got so far? We've got
Rufus,
Alexa,
Bard,
Siri, Bard, Rufus.
Yeah.
What else have we got?
Ernie, that's out of China.
Ernie,
Baidu.
Ernie.
Yeah, Ernie.
Ernie's the
Ernie
fastest milkman in the West. Oh, that's an old song. Very old. And Ernie, do you know what Ernie was? Ernie was the name of the computer that used to pick the premium bomb winners in the United Kingdom.
Really?
I think it might still be, yeah. So we've got Alexa, Siri, Bard, Rufus, and Ernie.
Yeah, that's a few, just to name a few. but that's where Amazon's moving. And I mean, in terms of the broader AI business at Amazon, it's not quite comparable yet to Microsoft. But and Andy Jassy saying that generative AI is still a small business at this point.
Can I ask you about AWS? It's the one where people either get very excited or get very underwhelmed as well. AWS is. It was, for many years, it was the secret of Amazon. Everyone thought it was just a shopping site, but then you looked under the hood and AWS was churning out enormous growth. Yeah. Now it's an open secret. How's it getting on?
It's doing well. It's pretty resilient in the quarter, 24.2 billion in revenue.
I should say.
Cloud computing, yeah, in line with revenues, 13% growth, which was sort of faster than what we saw in the previous quarter. And the guidance as well here was pretty key for the market. One of the things we saw last year was businesses cutting spend on cloud. Andy Jassy, the CEO, saying those what he called cost optimizations are slowing down and customers are willing to spend a bit more. And so that was, I think, a promising noise from the company.
Lovely.
We'll do Apple again later, I think.
Rufus sounds like a butler, doesn't it?
Yeah.
Rufus!
Yes. Well, that's the whole point, isn't it?
Yeah, I know, yeah.
They carefully pick these names. It's not sort of plucking a name out of a hat.
AI concierge.
Yeah.
That's right.
Right, thank you very much indeed for that. Arabile has strolled meaningfully to the wall.
I prefer the name Jarvis.
Jarvis?
Yes.
Was that in Magnum?
No, it's an Iron Man. It's Iron Man.
Iron Man, of course it is, yeah. What was the name of the butler in Magnum?
Oh, that's a good question,
Higgins.
actually.
Was it Higgins?
It was Higgins, wasn't it?
It was Higgins.
Can't believe even I know that. Anyway, speaking of things we all should know, this market is on an uptick then today, isn't it? Closing the market a little bit higher than for the week, particularly for the Dow Jones Industrial and the S&P 500 then, which are managing some gains, or another record close then for the Dow Jones. In fact, following on then from those numbers that we saw, we've just been speaking about them, Meta, Amazon, all picking up and beating expectations quite significantly there as well, adding a combined $280 billion to stock market value, having gained in extended trading. The Nasdaq Composite isn't up for the week, but it did manage to tick higher, 1.3% gains overall there. We're still looking towards Chevron, ExxonMobil, all due to report their numbers then before the close of trade then today. Treasury yields then, U.S. Treasuries did slump yesterday, that 10-year yield falling to a 1-month low, in fact. Benchmark rate falling by around 10 basis points, in fact, at some stage, to 3.86. Now sitting at 3.88 is where their 10-year yield is looking. So a bit of a pickup there. Still above 4 is the 2-year. So 4.22 is where we're currently sitting. Of course, investors have continued to peg back their interest rate expectations, those cut expectations, perhaps shifting them a little bit on to around May this year. Onto the European futures. No stocks closing lower yesterday. Of course, the earnings picture is still one that we're looking towards. In 45 minutes' time, the market could kick off the day a little bit higher to start. Steve?
Super duper, lovely. Thank you very much for that. Let's move on because we're going to hear from the CEO of CaixaBank, Gonzalo Gortazar. That's an exclusive interview.
Gonzalo, hola.
Sí. Hola, good morning.
Good morning to you. Nice to have you on board with us. Steve's with me as well.
Thank you.
We're just in the
nice
ad break.
To be here.
And we'll link back to you shortly. Thanks for joining us.
Excellent. Thank you.
CaixaBank reported a 76% jump in net profit in the fourth quarter amid higher lending income and lower loan loss provisions. The Spanish lender also plans to launch a new share buyback program in the first half. Gonzalo Gortizar joins us now, the CEO of CaixaBank. Gonzalo, thank you so much for joining us this morning. Let me just pick through the numbers. Net interest income, it feels as though we've set a high bar now thanks to the interest rate story. What happens across the course of 2024?
Good morning, Karen. Thank you very much for having me here. I think for a net interest income, after a very strong 2023, what we expect is a stability going forward, and hence to maintain our level of profitability. This quarter, we have achieved a return on tangible equity of 15.6%, up from 9% last year. And this is the kind of level we expect for next year, 2024.
Just talk us through some of the activity levels, because as interest rates start to move higher over the course of 2023, as we saw, some of the volumes were impacted in many markets. But I can see if I look at your book, the commercial activity was still strong through the year. So just explain some of the volumes and activity you're seeing despite the high interest rate levels.
Indeed, it has been a challenge to deal with this new rate environment. But I have to say we've been very satisfied to see that we have still been able to grow our business loan book, our consumer lending loan book. Yes, we have had an impact on the mortgage front that's directly related to the higher interest rates. But then when you look at the customer fund side, we have had a very strong year in terms of assets under management, up close to 19 billion euros in a year. So it means we're doing well relative to others. And also it means that if in a rising environment, we've still seen some decent level of activity. Now that we look into 2024 with a better rate environment and lower rates in the horizon, then we should have a higher rebound in activity. So I think it's pretty good news.
Gonzalo, I'm just pouring through the numbers, going through as many pages of the 80-page report as I can. But one thing that seems quite dramatic is year-on-year, fantastic improvements. But quarter-on-quarter, things have really slowed quite aggressively as well. Do you feel that actually the next quarter is going to be even more difficult, actually, and that we've seen, as you and Karen were saying, we've seen the high benchmark of banking profitability in Europe for this cycle?
Well, I wouldn't say so. I think you're right, Steve, indeed, that quarter on quarter what we've seen is a stability. This is what we project for 2024. And this is basically related to the fact that it's good news for the economy that interest rates have stopped in the way up. And now we're going to see a couple of quarters of stability. Then we will see them coming down. There will be some impact more into 2025 on lower rates rather than 2024. But for the time being, what we see is a stable environment in a new level. This 15% level of return is something that we see sustainable going forward.
I once upset a senior banker at Credit Suisse by saying that his cost-income ratio was out of control. It seems the complete opposite here. So credit where it's due at 40.9. That seems one of the lowest cost-income ratios I've seen in the banking sector. Correct me if I'm wrong, sir, but you must be quite happy with that level.
We are indeed, Steve. We've actually reduced our cost-income ratio, which is obviously moving it into the right direction. The lower, the better. From the 50% area last year to 40% now. It's a huge improvement in one given year. I'm not surprised. Our institution is the largest institution in Spain with 25% market share. We've gone through a large, successful merger that delivered us more than 1 billion of cost savings. So now we're reaping the benefits. That's it.
Can I ask you about non-performing loans, sub 3%, very low at this point in the cycle? Where does that go from here?
Well, I would say to the 3% area during 2024, there is some impact, obviously, of a higher level of rates in the economy, particularly in the mortgage portfolio. Spain is a country where mortgages are generally floating rate, and hence our customers and the customers of all the banks in the system are having to deal with higher payments. That's having some impact more in terms of what we call unlikely to pay rather than actual defaults, as we are very prudent. So I think from 2.5% to 3%, that's a likely movement during 2024. The good news is that we have a very high level of provisions, over 70% now, and these being mostly a portfolio that is collateralized with real estate. That's not going to have an impact in our income statement.
Gonzalo, there's a lot of positives in the numbers, but just to be super critical here, the net fees and insurance revenue, which is the other big cylinder now that many banks are going to be relying on as we get to that fading point of the NIMs, the net interest margin story. Your net fees and insurance revenues, very small increase over the year, just 1.5% versus the heavy lifting that you saw from net interest income, 54.3%. How can you diversify the bank further from here and manage to bump up those net fees for the next cycle ahead?
Well, thank you for that question, Karen, because it is the core of our strategy to grow non-interest income. What you have seen in 2023, generally in Spain and in some other markets, is that banks have stopped charging what we call custody fees that we used to charge to large corporates having excess liquidity with us when rates were negative. And the year-on-year comparison shows that line of revenues going out, and that's why the 2023 picture looks, as you say, relatively moderate with that plus 1%. Obviously, in the comparison in 2024, that factor is going to disappear. So the strength of our insurance business this year is up in terms of revenues, 19.6%, which is speaks by itself. All this is going to show going forward, and we are expecting to continue to be one bank that is particularly reliant on fees and insurance revenues, indeed.
Gonzalo, I spent most of this year, or certainly most of Davos, trying to pin down central bankers in Europe on rate cuts and as and when they're going to be as well. You don't have a problem with profitability. We've covered that as well. Your ROE, your return on tangible equity as well, solid double-digit figures at the moment as well. But how much will up-and-coming rate cuts, and we think we'll get something in the middle of the year, we don't know, how much will they affect your profitability going forward?
Well, I think interest rates coming down is good news for the economy, and it also shows this time I have to say that the ECB and generally central banks have been doing their job, which is obviously very good news for all of us. In terms of the impact of our profitability, it's not going to have any negative impact in 2024. As I mentioned, we expect return on tangible equity and return on equity to be probably in line with what we have achieved in 2023. Going forward in 2025, we should have, because we have some sensitivity to lower rates, we should have an impact on net interest income. But at the same time, what we're going to see is a rebounding activity in the economy. Clearly, that has to go with that lower level of rates and the various other initiatives we're having in the business. So we are not pessimistic at all, not only about 2024, but going forward 2025 and beyond. I think we have reached a level of profitability that is broadly sustainable.
Gonzalo, we've got about 30 seconds left. Can I ask you quickly about consolidation? It's been quite a while since the merger with Bankia. What comes next? Are you a consolidator at this point?
No, I think we're done. We have a 25% market share. In some areas, we have even a third of the market. We have plenty of organic growth now. We have the best competitive position in Spain. And while consolidation is possible, and I think in some cases may actually take place, it's clearly not us that are going to play that game at this stage. We've already done it and very successfully, I have to say.
Gonzalo, thank you so much for joining us and for taking the questions. Great to catch up with you today. Gonzalo Gortizar with us, the CEO of CaixaBank. We are counting down to the start of the European trading session, and the early signals are positive as we look to pick up on that Wall Street trade. Positive session we saw stateside. But don't forget, non-farm payrolls also later on today. We're going to get you warmed up for the session.
A warm welcome to the Squawk Box. These are your headlines. China weakness taking a bite out of Apple in extended trade, whilst executives caution on stalling iPhone sales, despite the tech giant beating on the top and bottom lines in the first quarter. Cost cuts do the trick at Amazon, with the e-commerce heavyweight posting record operating income, whilst Meta shares surge on bumper results and the firm's first ever divvy. Turbulent trade in Chinese equities, with them trading sharply lower before a bit of a dramatic recovery, and then they gave back a little bit again. This after the Shanghai Composite drops at one stage below the key 2,700 mark. And higher rates are driving a 76% surge in fourth quarter net profit for Spain's CaixaBank. The CEO telling Karen and myself he expects the momentum to continue.
If in a rising environment, we've still seen some decent level of activity. Now that we look into 2024 with a better rate environment and lower rates in the horizon, then we should have a higher rebound in activity. So I think it's pretty good news.
Take a bit of a focus then on the bond market here, and let's start it off in Europe. Then we saw actually the UK gilt market actually move slightly higher after the Bank of England decided to keep rates steady. It wasn't the same pushback that we had seen out of the US then, where perhaps investors are pushing back when they expect rate cuts to come to the fore. In fact, the BOE making note that rates are indeed under review and could actually be looking to cut interest rates sooner rather than later, perhaps as a sentiment to what the market is currently feeling. So you're seeing the 10-year gilt then out of the UK sit at 3.73, similar mark then to the 10-year paper out of Italy. Then we saw the 10-year bund at 2.17 then currently standing for the benchmark then across Europe. The 6.3 vote out of the Bank of England, perhaps the move then that has seen the 2-year yield even move at least 6 basis points higher actually out of the UK. Onto the United States then, we also saw the 10-year slump here falling to a 1-month low then yesterday out of the United States. The benchmark rate fell over 10 basis points, around 3.86 yesterday. We're now at 3.88 for that 10-year note out of the United States. Onto the more rate-sensitive paper then, the 2-year note at 4.226 currently. Of course, that fell 3 basis points then yesterday as well. Investors again pegging back those anticipations and those expectations for when rate cuts may come, guys.
Arabile, thank you. US initial jobless claims rose to a 2-month high at the end of January, suggesting cooling in the labour market. Claims rose by 9,000 to 224,000. Surprising to the upside, it comes as US-based employers announced plans to cut over 82,000 jobs in January, more than double the December figure. Attention now turns to the non-farm payrolls number due out of the United States today, with the economy expected to have added 180,000 jobs in December, according to LSEG estimates. That would be down from the November figure, providing further signs of a slowing labour market. The unemployment rate is expected to tick slightly higher to 3.8%.
We've got a terrific guest on this. In fact, I think one of the most informative, important voices on US employment is joining us in 1 hour's time. Neela Richardson, ADP chief economist. Please make a point to watch that interview, because I tell you what, you will definitely learn something about the US jobs market. In the meantime, the Bank of England voted to keep interest rates at a near 16-year high on Thursday, but ditched its previous warning that rates could rise again, instead saying that borrowing costs would be kept under review. Policymakers were split on the decision. 6 of the 9 members voted to keep rates unchanged. 2 voted for 25 basis point hike. 1 backed to cut of the same size. It was the first split with a hiker, holders, and someone wanting for a cut since 2008. Well, the central bank also reiterated policy would need to stay restrictive for sufficiently long, even as it slashed its inflation forecast for the coming months. Well, I called up with the Bank of England governor and started by asking him whether markets have it right on the timing of future rate cuts.
I'm not going to predict how many cuts at this point there are going to be.
But you do believe there'll be cuts in the second
half
of the year?
Let me put the framework, let me sort of do the framing. I think we've moved importantly on from a debate which was around how tight does policy need to be, how high do rates need to be, to how long do we need to maintain this stance to achieve sustained inflation. Now, I think the way I read the market, I think the market is in the same frame of mind as well. The market has to, of course, reach a view on when they think cuts are going to happen, because that's obviously how markets work. We are not going to commit to, it's going to be here and not there, or then and not then. But I very much hope that we're on a path which will allow us to conclude the answer to that question for how long will come, and we will get to a point where we say, yes, we can.
In terms of alignment, though, and again, you say the markets are broadly having the same thinking as the central bank at the moment. In the United States, there is a huge disparity between what the market is hoping for, 140, 150 basis points this year, and what the Fed is primarily saying, potentially 75 basis points. But you're saying actually the pricing in the gilt market, the pricing in the money markets is more accurate for the United Kingdom than it is in the United States?
No, what I'm saying at the moment is that I've set out how we're framing the issue in terms of for how long do we need to maintain the current stance of policy. We've published a forecast which is conditioned on the market curve, so you can see what our view is of what that leads to. Now, it does leave inflation, above target for quite a long period in that forecast, to be frank, but not massively above target. But it does leave it there for a while. So I'm not going to give a view on how many cuts there'll be and when they will be. But I think that that view that the market's taking is not one I object to.
There you go, Karen. Bit by bit, you're actually watching my interview. Yes. Unless you want to just watch Jack Reacher while you're doing it.
Well, I do note you look very big in the frame.
Well, there's a whole story about that, but I'm not going to go into. Nothing to do with me. It's all the technical side of things. Chris Hare is senior economist at UK, Eurozone and Ireland, HSBC, and rejoins us now. Nice to see you. How are you?
Yeah, not too bad, thank you.
Good. This sounds terrible to say, but I thoroughly enjoyed my time at the Bank of England yesterday. I don't know if I learnt anything about when the rate cuts are coming, but I learned that the Bank of England is comfortable with the market's assertions, which is slightly different from the Fed compared with the market. So I don't know if you want to pick up on that.
Yeah, I think the Bank of England's thinking probably isn't a million miles away from what the market is thinking.
That's the impression I got.
Yeah, I mean, you've got Andrew Bailey going out on telly saying the next rate move is likely to be down. Through the MPC's forecast, where inflation in the medium term is around about 2%, you can see that as a broad endorsement of those market rate expectations for multiple rate cuts. The one proviso, though, is that the Bank of England, like other central banks, wants more confidence that inflation is really falling back. So if you've got market pricing for around 4 rate cuts this year, I think if you really were to push Andrew Bailey on that, deep down, he's sort of endorsing expectations, but is he really thinking he wants to go 4 times this year?
They've got a problem, though. And again, I really enjoyed it. I spent 2 hours just looking through this vast document. And inflation dips to target in the second quarter, which is a real problem for them in terms of messaging, because then it goes up again. Whereas previously it kind of went down at a more sedate rate and got to 1.9, I think, was a lot later. I think it was in 2025. Yeah. So the messaging is going to be really tricky in the next couple of meetings, isn't it, as inflation gets to target, albeit temporarily?
Yeah, it's a bit of a wobbly inflation forecast, which is pretty similar to our forecast, to be honest. We actually think inflation in April and May is going to dip a little bit below 2%, but so much of that is to do with the fact that energy prices or household utility bills are set to fall back, and then temporarily you get inflation a bit below 2%. But actually what I find quite striking about the bank's forecast towards the end of this year, it goes back up quite a bit, and quite a bit more than consensus expectations. If you look at their kind of mean forecast that takes account of the balance of risks, it's back up at nearly 3% at the end of this year. So it is a bit of a tricky communications challenge, that's true. But I think the messaging would be, look through all those energy shocks. Ultimately, we're in a story where underlying inflation is coming down, but coming down somewhat gradually. And because of that gradual disinflation, at least in terms of our view, rate cuts are coming, but not yet. They'll take some time.
Unsatisfying messaging, though. We've got a governor pivot, but we didn't get a Bank of England pivot because you still had two dissenters suggesting there should be rate hikes. Very unusual at this point that you've still got two saying rates need to be higher from here versus the third dissenter was saying a rate cut. So very wide expectations from the voting members.
Indeed, a three-way committee split is always interesting. That's the beauty of policy making by committee. And we were actually quite surprised that there were still two members voting for rate increases. However, if Andrew Bailey is messaging towards the next move being cuts, my suspicion is that he wouldn't necessarily do that unless he thought that he had the majority of the committee on side. So although you've got those hawks on the committee, my suspicion is, and again, it's the beauty of committee decision making, you're going to have dissenters, that they're not necessarily in line with the majority MPC view. I think the consensus view is kind of behind that shift in a more dovish direction.
Have the hawks not seen the expected growth rates for the UK this year? I mean, the IMF was calling barely any improvement on last year, which was very slim growth.
Yeah, the growth outlook for the UK is soft, but I guess one of the reasons for that weak growth is weak productivity, and that's not necessarily a kind of disinflationary story. It's something that's pretty bad about the supply side of the economy. I think that they're looking, understandably, at some of those risks to inflation which are still there. It is not game over in terms of UK disinflation.
I knew he'd push back, and I and other journalists just pushed quite hard on what the government's up to. And I know I'm not getting involved in fiscal, but there was a nod to the autumn statement in the deeper dive that I did in the Bank of England statement yesterday. It was only a couple of decimal points of increase of inflation expectations on the back of the autumn statement. But I put it to him that the March budget, the spring budget, which is before the next March meeting, I mean, the Tories could pull something out of the bag here that could really kind of be a little bit of a wobble for the pound, for the gilt market, and indeed for his inflation expectations. Are you concerned about, I mean, Jeremy Hunt's a very responsible, quite dull man compared to previous incumbents. Are you concerned that there could be a bit of a fiscal problem which could affect monetary policy?
Yeah, I mean, I think the risk of a mini-budget type fiscal event...
yeah,
I think something like that, the probability of that seems fairly low right now. I think the government is really trying to push fiscal credibility, but at the same time, you know, it's angling towards tax cuts at some point. And at the margin, if we do see a little bit more fiscal stimulus, that could push up a little bit on inflation over the medium term. And of course, around the spring, we've got other potential inflationary things going on when we're thinking about a big increase in the national living wage, for example. Now, all of this I don't think detracts from that disinflation story writ large, but it points to a couple of those upside risks, which is keeping those hawks staying hawkish and potentially pushing out the prospect of rate cuts just a little bit later than market expectations. We don't see the first rate cut until August, for example, and that's one of the reasons
You're
behind
quite late.
that. Yeah. We are a little bit later than some. We do see rate cuts. We've got 25 basis points of cuts per quarter from August onwards, but just a bit later than what the market thinks.
I want to just push on to Europe because we had a bit of data this week. The PMIs yesterday a little bit mixed in terms of Italy, Spain versus, say Germany. What was your wash up from the week of the data that we've had?
Yeah, I mean, it's a little bit of a mixed bag across the different economies around the Eurozone, particularly when we're thinking about GDP data too. We're seeing strength in the periphery, surprising strength in Spain and in Italy. Germany is still looking very soft. I guess what we're focusing more on, though, front and centre, is overall inflation. And in terms of those Eurozone inflation numbers, again, it's inflation coming down, but a slight upside surprise relative to consensus. And I think it's one of those reminders that even though we're looking at disinflation, it's potentially a slightly bumpy road down. And drilling into the inflation detail, services inflation in the Eurozone around 4%. It's been kind of stuck at those sorts of levels for the last couple of months or so. So it's, again, a gradual disinfllation story.
Final question. I was going to say, would you prefer to watch unseen footage of me and Andrew Bailey or Jack Reacher? Just out of interest. Because
as a Bank of England nerd,
yeah,
any unseen behind-the-scene footage, including Andrew Bailey and you, why not?
Thank you, Chris Hare. So,
I thought you were going to go with Jack Reacher too.
I thought he was as well. I was convinced he was going to go Jack Reacher. Give me that look.
Right, great team.
Thank you. Because my best friend at CNBC, my colleague, my work wife, you know, she prefers Jack Reacher.
I'm sorry to hear that.
You did look pretty good in that shot, though. You're nicely framed up, looking larger than life.
My big noggin.
Exactly. Chris here with us, senior economist, UK, Eurozone and Ireland HSBC. Big fan of watching Bank of England coverage as well. And for more on whether the Bank of England governor thinks the markets could be getting it right on rate cuts, head on over to cnbc.com with me. And if you want to catch the full interview with Andrew Bailey, that I'll also
Unlike
be watching,
some people,
you can get that by subscribing to CNBC Pro. Coming up on the show, France's farmer protest leaders have told strikers it's, quote, time to go home after more than 2 weeks of outcry. We'll bring you details next.
Welcome back. Now, seven-time Formula One world champion Lewis Hamilton has announced that he will leave Mercedes and join Ferrari on a multi-year contract from next year, 2025, in one of the biggest driver transfers ever seen in the sport. We will, of course, be hearing then, of course, as well from quite a few people with regards to this one. It's a story that, yes, was quite significant for Ferrari as well as Mercedes. Lewis Hamilton having been with the company for quite a significant amount of time. But really the main reasoning behind that share price popping actually yesterday, it went up around 9% then across yesterday. A lot of people would have thought that it was really synonymous with the news of Lewis Hamilton having joined Ferrari or agreed to join Ferrari in 2025. But really, the company came out with full-year earnings, and lest we forget that, actually. They beat on the top and the bottom line then when it comes to the expectations for the fourth quarter, did Ferrari. This helped the luxury car maker actually put out a record set of profits for 2023. Here's the full numbers then. Full-year revenue coming in, rising 17%, right? That is to 5.97 billion euros. Net profit also going up to 1.26 billion euros, adjusted EBIT at 1.62 billion. Even managing to increase their shipments by 3% then to 13,663. So that luxury market still able to pull off gains here for Ferrari, and they're able to tick a lot higher than the company's CEO. So Ferrari CEO Benedetto Vigna saying that the record 23 results are there, and the ambitions that we have in 2024, together with the exceptional visibility of our order book, allow us to look at the high end of 2026 targets with stronger confidence. So picking up then and saying that a longer term aspect of the business is still looking good. This is the reason that this share price has gone up over 50% over a 12-month basis, as you can pretty much see with this graph behind me. Year to date, it's also managed to pick up 16%. So that tells you the significant moves then for the company, even forecasting revenue of 6.4 billion euros. So that would be higher than it is for 2023. As we said in other news, Lewis Hamilton joining Ferrari then in 2025, a significant move in the driver market out of Formula One. That is a big change because it changes things up as well as to who exactly will sit in what seat again for 2025. So the black overalls of Mercedes being swapped then for the scarlet red of the Scuderia Ferrari team. We'll be hearing then from Mercedes F1 boss Toto Wolff later today. Don't miss that first on CNBC interview. It's at 3:40 p.m. CET.
Arabella, I was reading Carlos Sainz's resignation letter, but still behind the wheel for Ferrari for the next number of months. So you've got to question the motivation when you're already sort of heading out to another rival.
Yeah, I think they're all professionals, aren't they? There's no way that Lewis won't, having got to the top of his profession, won't want to have the best possible season in the car that he's given at Mercedes. But more importantly, I think people have been banging on about why is it such a... I think it's a huge deal. I think it's absolutely enormous. And Charlotte's in Vision. She's here to talk about farmers. But the reason you're in Vision is because I think you've typified it beautifully. Go on, you were saying Lewis Hamilton leaving Mercedes is like...
Well, I didn't quite understand the buzz around this news, and then I saw someone on Instagram saying it's like Zayn announcing he's leaving One Direction. And now that's a reference.
But it's like Zayn announcing he's leaving One Direction and joining BTS or Boyzone or something, isn't it?
Yeah.
I think the most significant one here is, if you want to keep sporting terms, it's like when Luis Figo left Barcelona and went to Real Madrid.
That
would be more apt, if you ask me.
Spot on. Okay, lovely. Thank you very much indeed. You go and you're back. Yes, we'll carry on. It's me. Okay, the European Union has delayed plans that would require farmers to leave more land fallow in a bid to appease protesting farmers across the bloc. The rules, which seek to encourage biodiversity and soil health, will now not come in until 2025. France's main farmers union leaders have called on their peers to lift roadblocks that cause traffic chaos across the country for more than 2 weeks, saying they've been heard by the government and it's, quote, time to go home. Charlotte has plenty more on this. And you're not just here to talk about Boyzone or BTS.
Or Formula One.
Or Formula One. But well done, though. That's got to be your first foray into motorsports, isn't it?
Yes, absolutely. That was the whole extent of my
It's not your core competency, is it? It's not Simone de Beauvoir, is it?
No, not really. Yes, let's talk farmers then. So there was that press conference yesterday by Gabriel Attal. As you know, there's been a couple of weeks of protests and blockages on all the roads in the country, and there was a third basically batch of measures that the government was announcing there to try and quell these protests that you were saying. Then the main union representing farmers say it's now time to go home. They feel like they've been heard by the government. So the third amount of measures, the third batch of measures being announced there by the government, multiple ones, some more technical than others, but basically they had already announced that they will not phase out some of those diesel rebate that had been put in place, cut some red tapes, include food sovereignty in the law, etc., etc. So I won't go into the details because some are quite technical. But basically, Gabriel Attal yesterday saying that just giving the guarantees to farmers that agriculture will remain a priority at the heart of the government.
Our agriculture is a force and our pride as well. I say it here solemnly, there is and there needs to be an exception for French agriculture. I am realistic. I am realistic in the face of the piling regulations, of decisions that come from above, and that come sometimes from who knows who. The agriculture sector doubts and awaits for answers and solutions. We will not fail you, without any doubt.
That was Gabriel Attal, of course, the new Prime Minister, having his first big challenge there. He was giving this a couple of days ago in Parliament, giving the priorities of his government there. And to a certain extent, now he's quelled the protests, and a lot of these blockages have been lifted now. They had arrived all the way to Paris. Some said that's a big success already for the new Prime Minister, that the Attal method, firing measures, that's what he did at the Education Minister, and answering some of the demands and move on. And to a certain extent, that's worked here. Now, some other people say, look, basically, with all the measures announced over the past few days, that's the Macron government giving up on some key axes of its second mandate. One, the green agenda. Some pesticides that were supposed to be phased out won't be phased out anymore. That's one of the measures that have been announced. Another one, putting an end to whatever the cost, the policy that have been in place after COVID and, of course, after the war in Ukraine. A lot of subsidies been put in place. They were supposed to be phasing them out. Of course, we know that public finances being a priority for this mandate. Well, now they will be paying about 400 million euros there for farmers. Another one is Europe. Of course, here, President Macron, of course, always going with this pro-EU agenda, but here being quite critical about Europe and insisting that there's too much red tape, too many measures that are just squeezing farmers too much. And so that was one of the key messages. Finally, there was one on the Mercosur. We know that.
I was going to ask you about that. This is a big one, right? So you've got a pro-European president. One of the big deals that the Europeans have been trying to ink for many years is with the South American countries that would bring in a whole host of rural products. This can't possibly go through for the French, can it?
No, and they said it very clearly. Again, yesterday, Gabriel Attal saying it is out of the question that France will sign a trade deal with the Mercosur. So it's very clear. Bruno Le Maire also saying the same, saying we will not sign this. We have the way to block this deal altogether. So suddenly they will have to go back to Brussels and to Mrs. van der Leyen and see what are the next steps. Spain, for example, is not happy about that. Spain said they really want to have a deal with the Mercosur. So certainly a hot potato there on the table.
Superb. Thank you very much indeed for that, Charlotte, as well. I had an email.
Yes.
From a long-time correspondent, actually, long-time watcher as well. Just talking about the Bank of England as well. As usual, I think the Bank of England, like a lot of central bankers, behind the curve. Prices more entrenched, but they might well be abating, but not reversing earlier gains as well. But very interesting email. So thank you for that, Tom. But actually, it's the last bit which is damning.
Right.
He says it's Jack Reacher for me, by the way.
Not a Lee Childs fan.
It's about a score draw at the moment. I think we're at 2-2 at the moment. I've got a horrible feeling it'll be a landslide in the second half.
Well, Charlotte can vote too.
No, she can't.
I was watching the truth.
European stock markets are opening for trade. What we've got, don't forget, we've seen stateside very strong signals yesterday. The market paced higher. We had the wash up from tech numbers, a little bit more digestion from the Fed this week. And as a result, the Dow travelling up by more than 1% for the trading week, about a third up on the S&P 500. By contrast, the benchmark here in Europe has been fairly flat. Individual markets, though, the DAX has been down 0.6% over the course of the trading week, and similar size declines on the French market too. So setting up for some green today as a result, and you can see we quickly scooped up 0.5%, a very strong amount of green moving on to the heat map behind me. So it is a positive start this morning. Don't forget, there could be something that the market's watching later on today, and that is non-farm payrolls, very key for investors to get a take on the strength of the labour market at this stage. So it has been a fairly significant trading week as we had that wash up from the Fed, but also reaction to a lot of the tech numbers that have rolled across. We will close out the week with those payrolls numbers. Let's just take a look at the various different sectors and see where some of the stronger gains have been felt this morning. I can tell you it is pretty much a broad-based sweep higher, the exception just oil and gas, but media stocks at the top, while oil and gas gives back about 0.7%. The resources basket travelling north, we're up about 0.2, along with healthcare gains. Financials up about 0.5%. Very strong gains there. Every stock in the basket so far trading higher. Autos, race, we were just talking about the fortunes over at Ferrari, and we've got that stock up 1.1%. Technology, 0.6 plus, stronger gain this morning in lockstep with Wall Street. Household goods, 0.8 higher. Electrolux, one of the better ones. BATS also improving. And utilities, an improvement there by about 0.8 almost. We've got media stocks just slipping from the top spot. ITV is the top performer in the basket, but real estate now positioning right at the top. No shortage of commercial real estate fears this week, as we've had concerns dotted across 3 different areas from the United States to Asia to Europe with exposure in major banks. So interesting to see that push high today on the real estate basket. Let me take you to the individual indices, and the starting point for the FTSE today, 7668, and we've got a bounce of 45 points or 0.6%. One of the better performers of the core, outpacing stocks in France today. You've got the SMI moving up by about 70 plus points, so fairly decent start for Swiss stocks. To the periphery, it's the Spanish stock market that's ahead 0.5% and above 10,000 points. That's outpacing what we're seeing over on the French market at this stage, the Italian market, I should say, up 0.33%. We're still waiting for the DAX to open up. Let's push on to Spain and to CaixaBank and what we're seeing out of that bank. It reported a 76% jump in net profit in the fourth quarter amid higher lending income and lower loan loss provisions. The Spanish lender also plans to launch a new share buyback program in the first half of the year. The CaixaBank CEO has told us that the bank has felt the impact of higher interest rates.
It has been a challenge to deal with this new rate environment, but I have to say we've been very satisfied to see that we have still been able to grow our business loan book, our consumer lending loan book. Yes, we have had an impact on the mortgage front that's directly related to the higher interest rates. But then when you look at the customer fund side, we have had a very strong year in terms of assets under management, up close to 19 billion euros in a year. So it means we're doing well relative to others. And also it means that if in a rising environment, we've still seen some decent level of activity. Now that we look into 2024 with a better rate environment and lower rates in the horizon, then we should have a higher rebound in activity. So I think it's pretty good news.
You're looking at some market moves on the German listing of Danske Bank in the red. It reported fourth quarter profits in line with analyst expectations. The Danish lender said it expects 2024 earnings to be broadly unchanged from last year and announced a share buyback worth 5.5 billion Danish crowns. E.ON has released its preliminary full-year earnings for 2023. Stock is up slightly, as you can see, 0.8 plus. It reported adjusted core profit of 9.4 billion euros ahead of its own expectations. Investment activity picked up in the final 3 months of the year, particularly in its network business. Full numbers will be reported in March. To Mercedes-Benz, shares are higher after its industrial business reported preliminary full-year free cash flow well ahead of expectations due to lower working capital levels coming in at 11.3 billion euros versus a 9.9 billion euro forecast. The stock up 2.3%, Steve.
I'm delighted to say that Eleanor Ingleby has joined us now, head of high net worth at Atomos. We've been talking about just about everything apart from the markets and technology stocks since you came on set. So let's get back on track as well. There's so many things to talk about. And the thing that Karen and I started chatting about on Monday was, is this more important to look at central bank policy this week, or is it more important to look at technology? The answer, of course, is a bit of both. But where do you think? Where's your focus in what has been an amazing week for information?
I think everything is fighting for attention at the moment. As I said earlier, we've never had almost this much news going on. I think one of the most interesting things to see was the Bank of England's decision yesterday to see that actually one member of the MPC did vote for cuts. Now that's a really big shift in tactic. But I still think we won't see anything tangible until later in the year, which is market expectations as well. At the same time, we've had a huge amount of tech stocks earnings reports. And what's interesting is that last year it was all about the picks and shovels. But actually this year it seems more about monetization and how they're actually using AI.
I'm really glad you said that, because I've had we've had to do so many panels, especially at the World Economic Forum and affiliate events as well, where the words picks and shovels come up all the time. And as you quite rightly say, you get an amazing multiple for being picks and shovels and being slightly agnostic about what people do with them, but you just want to sell them to them as well. In terms of monetization, I think it's great, but it goes way out of the tech sector, the monetization of AI. It goes to it's a bit like saying to a company, have you got .com or have you got email addresses? Of course you want every company to have it. Same issue with the cloud. Is it the way with AI that every company's just got to get on board?
I think we're seeing that, and already I think we've spoken about this before. AI is so much more present than we realise. It is being built in, but what's really interesting is the growth of the large language models and generative AI. And that's what's relying on the cloud to really succeed. And that's still very much early stages, much earlier than perhaps the media gives the impression of.
It's very mixed, the commentary, right? So there is a view that the implementers will win this year. That was from the CFO of Google, Ripora, telling me in Davos. But equally, we're hearing that we're still at the starting point in terms of coming up with use cases. So it feels like you come up with a use case, you have to quickly implement it to get the outcome. What did we see from the tech earnings that suggests that there is implementation going on?
I think we're seeing it being woven in better, and the capabilities for expansion are being built in. So we look at Amazon and their bumper results. A lot of that came from the Amazon warehouse services, building that cloud infrastructure that these AI programs can then run off in the future.
It's not that exciting though, is it? I mean, we've been talking about cloud for a long time, and to get another slight bump higher in cloud numbers thanks to the AI journey, it's not really justifying the hype that we've had through 2023 on the AI story.
No, and I think that's why it ticks back to the monetization. We don't want to get too caught up in getting too overexcited about things that haven't come in yet. It's actually looking at things such as, daily users, take up, and whether that capability is built in. And we saw that with the poor results from Intel, not being able to build the warehouse they expected and therefore suffering for it.
Is Meta a more interesting play then, based on what we're seeing? It's using the AI to try and maximize its ad targeting. We know that ads are the bulk of all of its revenue. Is it more of a traditional way to play the AI story because we know what the revenue model looks like at Meta?
I think it's yet to kind of unwind whether that will play out better or not. But I think what was interesting about Facebook's results, there was nothing not to like. They almost swept aside every controversy they've been battling. If you think of 2023, when Zuckerberg said it was the year of efficiencies, they really have changed tactic and almost built the solid foundations to grow.
In your universe, I presume you can invest pretty much anywhere in equity space, can you? What is the attraction of the US is obvious. We've just spoken about it. They have high growth, big company with dominant positions and solid cash flow. Do our viewers have alternative propositions, albeit at a smaller scale, elsewhere? And primarily, I guess I'm asking in UK and Europe.
I mean, the UK has struggled. If we look at it in a chart against the US or even emerging markets, it has been a laggard for quite a while. Any of the UK companies where we have had exposure have to a large extent generated a lot of their revenues from expanding into other markets. So it's a challenge to pick one company that you could say, this is the potential. What we always caution our clients against is putting too many eggs in one basket, overloading their exposure to things such as the US tech stocks. If you look at the year they had in 2022, it was somewhat more challenging. So it's just being careful not to build in too much exposure.
Can I ask you about the Fed and the psychological damage from this week? Is there any? Because the market took fright to an extent earlier in the week that it's not going to be much in terms of rate cuts. Not everybody bought into that. They're saying it's just posturing from the Fed. They're still going to be moving earlier rather than later. But do you think there's been some damage done this week in terms of the expectations of early rate cuts?
I think it slightly shook confidence, and especially when we had quite a weak start to January anyway, the markets are certainly holding their breath a little bit, waiting to get more tangible evidence of those rate cuts coming in.
If we get the evidence, what happens? Is it market breadth? Is it the usual areas, the usual suspects around technology where investors pile back into? What's the first move that you expect if we get another glimpse that we're back on in terms of the rate cuts and imminently?
I think it'd be quite, in my mind, quite a broad easing of flow. So just people relaxing slightly more, investors not being quite so tough on some of the results. If you look at, to go back to the tech stocks, Microsoft and Alphabet, there was nothing actually inherently wrong in the results. They just weren't quite as high as the markets were expecting. So I hope that's what we'll see as a slight easing of expectations.
When you say don't put your eggs in too few baskets, or that's absolutely pertinent, of course, but because of the weighting of these 7 stocks, you're going to potentially end up underweight if you don't if you want to go in and kind of do it by market cap. It's very tricky not to have exposure to them as well. But let me park that. Where else would you advise people to put their money? Given the fact that technology, again, it has this predominant position, but we just got to be a little bit more cautious with it.
So obviously can't advise direct stock approaches, but a company a company we've held for a bit is something like Howden Joinery. Really interesting, almost going back to that bricks and mortar approach of selling a tangible asset. And they're a fascinating UK company because they've expanded quite well abroad. So it's looking for items such as that, which tell a slightly different story and don't correlate necessarily with some of the bigger US tech stocks.
I hold my hands up. I was in Howden's to buying something last year, actually. It's a very interesting proposition. The only thing I would say is you've got Travis out there, you've got Jewson's out there, you've got all kinds of other small and medium-sized large players as well. It's a very crowded space.
It is. But they've been quite resilient throughout it. So it will be interesting to see how they progress. But it does, again, as I said, like most of the UK stocks rely on building that exposure elsewhere.
I want to bring up one of the risks to markets, commercial real estate. That's come back this week after the Fed giving guidance effectively of a later rate cut than anticipated. We then saw earnings from a major bank, one of the consolidators and the regional banks, New York Community Bancorp. We saw across in the Asian markets, Azora Bank also having exposure to US office loan portfolio. And we saw, of course, Julius Baer also having to move to take a fairly large provision thanks to commercial real estate. How do we navigate that commercial real estate story this year? It's been lurking in the backdrop. Is it a bigger risk this year?
I mean, it has been a shaky market. If we look at it dominating the headlines last year, to take an example, certainly challenges within China, a shaky market in the US recently. I think the commercial real estate is still having a slight hangover from the pandemic of working out where it sits and what its uses are.
Is it fair to say this is a typical area for high net worth individuals in the past? They would have loved this area of the market.
Absolutely. It was known as much more stable, able to actually deliver reliable inflation-proof returns. But I think now there'd be a lot more due diligence going into any investment in that sector.
I've also been given a couple of book recommendations.
Have you?
Off camera, that's what we were chatting about, books.
Right.
Yeah. Scary Smart and The Coming Wave, both about technology and AI, yeah?
It's good to understand it, isn't it? As we said, we all speak about it so much, there's just an assumption that we all know what we're talking about.
Yeah.
It's always good to keep learning.
I couldn't agree more, yeah. Sometimes it's quite hard work to get in some of these subjects, which I know less about. But it's, you never feel less informed by reading it. So, thank you very much indeed for those. I'll put that on my homework list.
Thank you.
Thank you.
Eleanor Ingleby with us, head of high net worth at Atomos. I'm going to just take you to a couple of other stocks we're watching. Wizz Air shares moving higher in early trade after the budget airline reported a 14% rise in January passenger numbers on the year. The load factor fell slightly to 82% from 86% a year ago. And we've been closely following markets across mainland China today amid a volatile trading session. Equity markets rebounded sharply after the Shanghai Composite dipped below the key 2700 mark. You can see 2730 at this stage. We are currently down almost 1.5%.
You know, we're missing one company. Because you and I have spoken to BBVA's CEO this week, we've spoken to Santander's executive chair, we've spoken to Caixa, We need to do Bank Sabadell.
Yeah, it's been a big week for them. I saw a lot crossing on Super Thursday, and this is when we're going to dig into more.
Why don't we rectify that by speaking to the CFO of Banco Sabadell after the bank posts a miss on fourth quarter net interest income? That conversation after this break.
Banco Sabadell missed on fourth quarter net interest income expectations following a drop in lending volumes. The bank forecast low single-digit net interest growth in the coming year after a rise of 24% in 2023. Leopoldo Oliveira joins us now, the CFO of Banco Sabadell. Thank you so much for joining us today. Let me ask you about that drop that you were expecting in the lending income growth this year. That's quite a reset as we talk about high single digits down from a 24% increase last year. Just walk us through that reset.
Thank you very much for inviting. Basically, that's going to happen to most of the banks who are linked to floating rates or to floating loans. So we had a significant increase last year because of the hike of the rates. And now the rates are starting to point downwards. Still 2024 for us is going to be positive because the asset price will take longer to reprice than the deposit side. But of course, the numbers that we've seen in the last 12 months will just not be possible. No, we'll flourish that the numbers we have right now.
We were just talking to CaixaBank before about the market dominance they have in the retail business. Does size matter at this point, and just how competitive are we seeing the business for deposits?
I think the business for deposits has been fairly resilient throughout the year. No, for example, we have our loans have delivered more than our deposits, and we've generated about a couple of billion of commercial gap. So I think we are being very, very restrained on that regard. I mean, very, very resilient.
Leopoldo, we spoke to many of your peers from Spanish banking over the week, actually all the major banks as well. And it's international operations where there's a lot of excitement at both BBVA and at Santander as well. What about Banco Sabadell? I know you've got operations. In fact, I'm on your website looking at various international jurisdictions. Where's the best performer and where is more problematic?
Well, we're mostly Spanish banks, but we do have some franchises outside. So, for example, in the UK, we have TSB, which is a big franchise, and it's doing very well. So this year, they're making more or less the same profits or the same return as the group. They more than doubled their results and the contribution to the group, as much as 120%. They made 175 million pounds of net profits, and we are very confident that this franchise is going to do much better in 24 and even moreover in 25 and 26. We have another small franchise in Mexico, which amounts to around 4 or 5% of the capital of the group, which again has been restructured and it's doing better. The return on tangible increased this year, and we are very confident also that it's going to increase in the coming years to get at or above the group levels.
Yeah, quick word on TSB then. I guess that's where I was going on really knowing about the international exposure. How tough is UK banking? From your numbers, with the 71% rise in net profit, it looks pretty solid as well. But do you have any concerns that the best is behind us?
I think we've bottomed in terms of NII, for example. Fourth quarter, we had a drop at TSB and also I think at UK banks. But we believe that this is the bottom of NII. From now onwards, I think we're going to see some recovery, especially driven by the structural hedge that all banks have and TSB has. Nevertheless, 2024, we expect it to be a flattish year because that is a tailwind, but we have headwinds such as the mortgage compression and competition, which is still very high, and some more deposit repricing. The good news, in my opinion, is that 2025 and onwards should be much better because the structural hedge will still kick in, probably in a broader term, and we will have less probably competition, both in mortgages and deposits. So we are expecting that the profitability of the franchise still has some room for improvement in the coming years.
Leopoldo, do you just want to talk us through the restructuring of TSB, job cuts, branches to close this year? What sort of shape will the business be in 12 months' time?
I don't think it's going to be a major restructuring. So we're just fine-tuning, especially with regards to the branches. It's just a very small number of them. But we're trying to change the way we relationship with our clients. And therefore, we are doing some minor changes on that kind of relationship. It does affect also a lot of people who are not within the workforce, but that were helping us.
Can I ask you about the net fees and commissions? And every banking CEO in Europe knows that we are seeing now a shift away from the interest rate story towards fees. This is going to be so much more relevant in 2024. I can see a drop over the course of last year, down 7%. Can you correct that fall this year? Can you improve your performance around net fees and commissions?
I think in the net fee and commission next year, we're going to have several trends also. So I think most of the lines are going to perform well. Most of those lines who are related to really value added that we can add to our clients. On the other hand, we still have to cope for the reduction, for example, of some administrative fees, which were raised during the course of the period where the interest rates were negative. Now that interest rates are positive, we don't have to charge those structural costs through this fee and commission line because we are already getting some income through the interest rates, which we didn't do before. So we're still in that process. Nevertheless, we had a one-off in 2023, which we're not going to have in 2024. So we're expecting a much better evolution for 24 already.
Very interesting press conference with your CEO, Mr. González Bueno, yesterday. And reporters asked him, are you getting ready to sell TSB? I mean, you'll be aware of this. Is that why you're getting the cost down? The answer was no, we're not getting ready for sale. We like our perimeter as well. But let me ask you a broader question rather than reiterating that. How does international expansion, how does your international profile suit you at the moment? You talked earlier about small franchises in Mexico and elsewhere. But are you happy with your international profile or would you like to expand it?
No, I think we're happy with the perimeter that we have. We believe that the international franchises, as well as the Spanish one, still have room for improvement, and therefore to increase the 11.5% return on tangible that the group has today. We are fairly confident that we're going to improve that already in 2024. That's what we guided for yesterday. And that's also going to happen in the international branches. No? So we believe that there's quite a lot of room for improvement in those franchises, but we must not forget that at the end, the core of the bank, it's Spanish and it will remain being Spanish.
I just want to move on to the non-performing loans, because the non-performing assets here, you've got effectively the stage 3 ratio at 3.5%. That still looks fairly low at this point in the cycle. The gross NPA ratio 4.1%. What's the highest point you're expecting at this stage in the cycle?
Well, as a matter of fact, we are fairly confident that those rates may be going down already in 2024. No, they've been stable in 2023. The NPA ratio has gone down, and we believe that that's going to improve going forward. Why? Because the environment is reasonably benign. So we have the macro, the GDP in Spain is going to grow above 1.5%, or perhaps even a little bit better, because 2023 numbers just surprised on the bright side. Unemployment is coming down, so it's in a good trend. Inflation is also coming down. There is no bubble in real estate as opposed to other geographies in Europe. And then because of the mix of our balance sheet, we have around 60% of mortgages which are fixed rate mortgages. So we are fairly confident that we're going to have a good year in 24 in terms of asset quality and therefore cost of risk. And unless something breaks, I think this trend should continue also in 2024, especially now that rates are coming down.
Really nice to see you today, sir. Thank you for your time and taking all our questions. Leopoldo Alvear, who is the CFO of Banco Sabadell. Coming up on the show, the Bank of England holds fire in a contentious three-way split, but opens the door to its first rate cut. We'll bring you part of my conversation, which Karen hasn't quite seen yet, with the Bank of England Governor Andrew Bailey. That's coming up next. A warm welcome back to the last 30 minutes of Squawkbox, and it promises to be a good one, I can assure you. China weakness taking a bite out of Apple in extended trade, whilst executives caution on stalling iPhone sales, despite the tech giant beating on the top and bottom lines in the first quarter. Cost-cutting doing the trick at Amazon, with the e-commerce heavyweight posting record operating income, whilst Meta shares surge on bumper results and the firm's first ever dividend. European equities trading near a 2-year high. Investors looking ahead to today's non-farm payroll print. We're going to preview the jobs report with the ADP chief economist Neela Richardson. That's coming up next. And higher rates drive a 76% surge in fourth quarter net profit for Spain's CaixaBank. The CEO telling this show he expects the momentum to continue.
In a rising environment, we've still seen some decent level of activity. Now that we're looking to 2024 with a better rate environment and lower rates in the horizon, then we should have a higher rebound in activity. So I think it's pretty good news.
European stock markets have been trading for half an hour so far, and we are still marching higher, particularly on German stocks, up 0.6% versus about a third up on the UK and French markets. It's still a fairly significant risk on event for markets today. We've got non-farm payrolls as we look to close out the week after what has already been a fairly monster trading pattern on the back of the Fed and tech earnings. The wash up here in Europe this morning, you can see it is stronger, but we're not reaching for the higher levels at this stage. In terms of sectors, let's take a look at the individual ones. At the start, we had just one patch of red, and that was around oil and gas. Basic resources, healthcare now reversing into negative territory. Auto stronger, that's raised towards the top, up 1.4%. Travel and leisure strong from the outset, up 1%. Real estate, top performer now just slipping, but still strong this morning. Food and beverage up 0.8%. Stocks on the move. Let's take a quick look at some of the individual players. You can see Danske Bank up 6.1% on the back of fourth quarter numbers. The company also launching an earlier than expected share buyback, so that has moved the stock. E-commerce player Zalando is up more than 4%. Weaker players, the shipping giant Maersk is down at 2%. Electrolux giving back some territory, and also Delivery Hero 4.2 down. Now the market taking stock of its move to shed its stake in Deliveroo this week, and you can see it is a soggy performance today. Arabile, more stocks to watch today too.
Yeah, indeed, Karen. So shares in German software company SAP are higher than in early trade. That's after Jefferies upgraded the company to buy from hold, saying double-digit revenue growth is likely beyond the current full year, with cloud growth a lot better than expected. So you're seeing that share price go up 1 2/3% there. Italian shoemaker Geox is sharply lower. That's after posting a drop in full-year sales, while guiding 2024 revenue in line with the previous year. That stock down a big 6% on that one. Steve.
Thanks, Arabile. US initial jobless claims rose to a 2-month high at the end of January, suggesting cooling in the labour market. Claims rose by 9,000 to 224,000, surprising to the upside. It comes as US-based employers announced plans to cut over 82,000 jobs in January, more than double the December figure. Attention now turning to the non-farm payrolls number due out of the United States today, with the economy expected to have added 180,000 jobs in January, according to LSEG estimates. That would be down from the December figure, providing further signs of a slowing labour market. The unemployment rate is expected to tick slightly higher to 3.8%. This after private sector job report showed that payrolls increasing less than expected in January. I'm delighted to welcome back, we always are delighted to welcome to see Neela Richardson, Chief Economist at ADP. Neela, we always love seeing you. And one thing about you, which I remember from our first meeting, is Neela says, yeah, the payrolls are good, but my data's better. I haven't forgotten that. So ADP has a lot more data points than other measures out there as well, and a differentiation between the payrolls and what have you. Tell us what your surveys are showing about the labour market, because to the rest of us, it looks incredibly strong still, despite a little bit of a slowing down.
Right. So ADP pays about 20% of the U.S. workforce. So we actually get paycheck data. directly. It's not a survey, and that's why I really love this data set. It's very rich, it's very fine-grained, it's very comprehensive across the country, and what it shows is that, yes, the labor market is cooling, but hiring is still strong. If you looked at that 107,000 jobs that we saw for the month of January in a normal economy, in a normal year, pretend there wasn't a pandemic, you'd take that number every single day. It's a solid number. But within that solid number, you see pockets of weakness. Manufacturing has been in a virtual slump all year, and we're starting to see a pullback in industries tied to white-collar jobs, hence the layoff announcements that you previewed earlier. So there is some weakness brewing. Overall, solid number.
And yet, manufacturing just had one of its best ISM figures overnight since January 2022, I think it was as well. It's still in contraction. So even in those, but it was getting closer to that 50 mark as well. So is there a sign that the manufacturing job losses are abating or actually picking up?
I think it's too soon to tell. Those numbers are a little lumpy. They may not move in a straight line. And remember, manufacturing is a cyclical industry. It's tied to interest rates. That is a sector waiting for the Fed to start cutting. We don't know when that happens, and we don't know by how much. But it's one of the sectors that would benefit from a rate cut.
Just as a follow-up on that, I spent a lot of time speaking to the UK central bank governor yesterday about monetary versus fiscal. The fiscal stimulus via the CHIPS Act and indeed IRA that has gone into manufacturing in the US and the reshoring trend as well, the near-friending, the localization, these are all significant structural changes for the US economy as well. Are they set to, in the medium term, actually boost that manufacturing profile?
I think you can make a case that the industry is in absorption mode and it's absorbing all of these policy changes. And the trigger for that actualization of those change, I think, is lower interest rates. So when all of these things collide, I think manufacturing's in a good stead. But it comes at a time when the service sector, like leisure and hospitality, been the stalwart of the U.S. labor market gains, is starting to slow down, as with those white-collar jobs I said earlier.
Right. We've got the anomaly around a couple of sectors, as you point out. What does that do to the overall mix of the headline unemployment level? You know, what sort of skew are we going to see because of those really hot sectors still?
Well, it's interesting because that skew has even changed in the last 3 months. What's been solid over those months is healthcare and education. There was a pause in those sectors coming out of the recovery, and it was really leisure and hospitality dominating gains. Now we're seeing a slight shift. So we'll see if healthcare can stand up. This is not a cyclical industry. It's an industry where there's a lot of demand, especially with an aging population. And it's going to be curious to see if those gains stay the course through 2024.
For a long time, economists have looked at the tipping point between unemployment and inflation. Last year, everyone was tossing out the Phillips curve. As we look through 2024, more normal conditions, we get much further past those post-pandemic trends. Do things like the Nauru and Phillips curve come back?
I think you can't count it out. Wages are really, in my mind, the bridge between the labor market and inflation. And we've seen wages moderate quite a bit over the last year. We track wages very sharply at ADP because we pay people. And so that moderation, I think, has basically faded any threat of a wage price spiral. It doesn't exist in the data, and that gives the Fed some latitude to do what it wants when it comes to interest rates without worrying about wages triggering inflation again.
So what do you say to investors saying, well, it's unusual to be setting monetary policy using some of the labour market data because it's such a lagging indicator? Do you feel as though it is a bit rearview mirror even at this point as we're trying to set policy for the future?
I think you have to. It has to be a player in your decisions. Right now, it's a really great sweet spot for the Fed. They have low unemployment and moderating wage growth. There's no threat of a recession anytime soon. So they have a lot of power in their decision making, but I'm sure they're looking at all kinds of data, consumer data, retail data, productivity data to make this decision. You could get kind of lost in all these data points. So getting a clear course to a rate cut is going to be really important for them.
It feels as though there are points in time where things can change. The narrative that we knew before can be different in future. And this time round, I was looking at some of the announcements from, I think it was one of the big logistics companies this week, and saying, look, we're cutting jobs and those jobs are not coming back. We're going to be using AI, we're going to change the way we operate. Are we at an important junction when it comes to the labour market? Because we do have this AI story. We don't know how those use cases are going to play out, and we don't know how workers are going to interact with the technology. Does the Fed need to be very careful at this point that it doesn't create economic scarring, encouraging companies to really accelerate towards the technology at the expense of workers having positions in future?
Yeah, I think the Fed is going, it's curious, your question, because AI is a game changer in so many ways. And the Fed is going to have to start thinking both short-term and long-term. Remember, the Fed's actions are short-term. They're cyclical. They're right now. They're the next 6 months. But AI and tech innovations are medium to long-term. And we really don't know. The world doesn't know how they're going to play out in the labor market. My sense is that it's going to create jobs in some sectors and maybe augment or lower jobs in other sectors and maybe reduce jobs in other sectors. So we're looking at the warehousing. We don't know if that's a structural change or a cyclical change, and time will tell. But I think of it as a change in the U.S. economy from digital-based to people being more in the service industry after the pandemic, wanting those services.
Neil, I've been taking a sneak preview, a look at your profile on your website, because actually I wanted to check something, and actually one of your areas...
dangerous this early in the morning. Okay.
The photo's a lot more flattering than my one on the website, I tell you. I look like her granddad. But one of the things you're a specialist at is women in the workforce as well. And I'm interested in workforce participation more generally as well. I kind of struggle sometimes to understand why the US participation rate is still stuck in the very low 60s. I think women in the workforce is even lower than that as well. Why do we have, and maybe there's two questions in one, why are the participation rates stuck in the low 60s? And again, I guess as a supplementary question, why is the women's workforce participation still that much lower?
You know, that's a global issue. We've seen a world's labor force participation going down since the 1990s. Part of this is an aging demographic story. If you look at the prime age workforce in the United States, 25 to 55, it's actually recovered back to 2019. Women's labor force participation for prime age women actually hit a record over the summer. I credit Beyonce and Taylor Swift. Obviously, they're driving the U.S. economy, at least during that period in the last 6 months.
Because they created inflation all around the world.
Exactly.
I mean, the Swedish inflation went through the roof when Swiftie was in town.
They were really important drivers. Women had a great 6-month season, but when you look at the ADP data, you see a really curious thing going on. More women are working, but more women are working part-time. And if you look at hours worked per week, it's lower now than it was before the pandemic. So those gains are vulnerable. Just because more women are working, it doesn't mean they're working more, and I think that's something to watch. The reasons could be a multitude of reasons, from family and home to just the sectors that they're in being more vulnerable to job loss and job cuts. It's something to watch, something we'll be researching.
I've got to say, I'm hearing more and more about job sharing though, and senior positions where you would not have seen that in the past. Two women perhaps wanting to share a job over the course of a week. Surely that trend's positive because the flexibility is now working for women.
Yes, if the choice in work arrangements, and we've seen more work arrangements possibilities, and that's really great for women who can work remotely. But most women, and this is the thing, are over-concentrated in jobs that require you to be on site. Nurses, teachers, childcare workers, and those arrangements may not be available. So yes, for women in some industries, banking, technology, information, that is a nice new part of their amenities at work, but not all women can have that.
Do we want to go there on the Oscars then? Because Margot Robbie, who you just referenced, she didn't get a Best Oscar nomination.
No, Barbie. She was very good.
It was good.
I mean, she has my nomination, being an economist, for what it's worth. She not only did a great acting job, she created a lot of wealth in the process.
Yeah.
So I think that's a win.
I don't know. I loved it. I loved the movie. I don't know if it was Best Oscar. I think what I did see, which I don't know if you guys have you seen Nyad? And it's really, really brilliant movie. But Annette Bening's been nominated. Wow. And I think that was brilliant.
Well, you know what I'm watching, and it's not that.
Oh, gosh. You don't want to know what she's watching. Carey Mulligan, Emma Huller, Sandra Huller, Emma Stone and Lily Gladstone are the other nominees as well. We always love seeing you, Neela. Thank you very much indeed for your time today. A lot of fun as well. Neela Richardson, who is Chief Economist at ADP. Now, as I may have mentioned, the Bank of England voted to keep interest rates at a near 16-year high on Thursday, but ditched its previous warning that rates could rise again, instead of saying that borrowing costs should be kept under review. Now, policymakers were split on the decision. 6 of the 9 members voted to keep rates unchanged. 2 voted for a 25 basis point hike, whilst 1 backed a cut of the same size. It was the first 3-way split since 2008. The central bank also reiterated policy would need to stay restrictive for sufficiently long, even as it slashed its inflation forecast for the coming months. Well, especially for Karen, I caught up with the Bank of England governor and started by asking him whether markets have it right on the timing of future rate cuts.
I've set out how we're framing the issue in terms of for how long do we need to maintain the current stance of policy. We've published a forecast which is conditioned on the market curve, so you can see what our view is of what that leads to. Now, it does leave inflation, above target for quite a long period in that forecast, to be frank. But not massively above target, but it does leave it there for a while. So I'm not going to give a view on how many cuts there'll be and when they will be. But I think that that view that the market's taking is not one I object to.
Well, with the UK budget in March and the scars of the September 2022 mini budget still fresh, for Karen, I also asked the governor what concerns he had over the Conservative Party's plans and for potentially upending the central bank's progress.
It's not for me to preach on what fiscal policy should be. That's for the government to decide. I would just say that I think there were some quite clear lessons learned from the episode of September, October, year before last, and I suspect those lessons remain. But it's not for me to preach about what fiscal policy should be.
And for more on whether the Bank of England governor thinks the markets could be getting it right on rate cuts, head over to CNBC.com. And if you want to catch the full interview, Karen, with Andrew Bailey, you can get that by subscribing to CNBC Pro.